Question 1. A life insurance policy owner makes a collateral assignment of their policy. Which of the following statements accurately describes the effect of this action? A. The policy ownership is fully transferred to the assignee until the debt is repaid. B. The policy's cash value is reduced by the amount of the assigned debt. C. The policy rights are temporarily transferred to the assignee as security for a debt. D. The beneficiary designation automatically becomes irrevocable for the duration of the assignment. Answer: C. The policy rights are temporarily transferred to the assignee as security for a debt. A collateral assignment of a life insurance policy means that policy rights, such as the right to receive the death benefit or cash value, are temporarily pledged to a third party, typically a lender, as security for a loan. The policy owner retains all other rights of ownership, and the assignment is only effective up to the amount of the outstanding debt. For example, if a policy with a $500,000 death benefit is collaterally assigned for a $100,000 loan, the lender receives $100,000 upon the insured's death, and the remaining $400,000 goes to the named beneficiary. Always remember that a collateral assignment is a temporary pledge, not a permanent transfer of ownership. Question 2. An individual applies for a life insurance policy and fails to disclose a pre-existing heart condition, which is a material fact. The insurer discovers this condition 2 years after the policy was issued and after the insured has passed away. Which of the following is the most likely outcome under the incontestability clause in Canada? A. The insurer must pay the full death benefit as the incontestability period has passed. B. The insurer can deny the claim due to material misrepresentation, regardless of the time passed. C. The insurer can only reduce the death benefit to what the premium paid would have purchased if the true facts were known. D. The insurer can deny the claim if they can prove fraud within the 2-year period, but not after. Answer: B. The insurer can deny the claim due to material misrepresentation, regardless of the time passed. In Canada, while the incontestability clause generally prevents an insurer from denying a claim after 2 years for material misrepresentations, this clause does not apply if the misrepresentation was fraudulent. If an applicant intentionally concealed a material fact, such as a serious heart condition, with the intent to deceive, this constitutes fraud, and the insurer can void the policy and deny the claim at any time. The key here is the distinction between an innocent misstatement and a deliberate, fraudulent concealment. Therefore, always ensure your clients provide accurate and complete information on their applications to avoid future claim denials. Question 3. Which of the following characteristics is unique to Canadian segregated funds compared to traditional mutual funds? A. Segregated funds are regulated by provincial securities commissions. B. Segregated funds offer daily valuation and redemption options. C. Segregated funds typically offer maturity and death benefit guarantees. D. Segregated funds are primarily invested in publicly traded equities. Answer: C. Segregated funds typically offer maturity and death benefit guarantees. A unique feature of Canadian segregated funds, which are insurance contracts, is that they typically provide guaranteed death benefits and maturity guarantees, often protecting a certain percentage, e.g., 75% or 100%, of the principal invested. Unlike traditional mutual funds, which are securities and do not offer such guarantees, segregated funds offer capital protection to clients, protecting them from market downturns at specific points in time. These guarantees are backed by the insurer's general account and are a significant reason why investors choose segregated funds over mutual funds. Always remember that segregated funds are an insurance product designed to offer investment growth with a safety net. Question 4. A client, aged 60, has a paid-up whole life insurance policy with a substantial cash value. They need access to funds but want to avoid surrendering the policy and incurring a taxable disposition. What is the most tax-efficient way for them to access these funds in Canada? A. Full surrender of the policy for its cash value. B. Partial withdrawal from the policy's cash value. C. taking a policy loan against the cash value. D. Receiving policy dividends as a cash payment. Answer: C. Taking a policy loan against the cash value. Taking a policy loan against the cash value of a life insurance policy is generally the most tax-efficient way to access funds in Canada without triggering a taxable disposition, as the loan itself is not considered taxable income. Unlike a full surrender or partial withdrawal, which can trigger a taxable gain if the cash value exceeds the adjusted cost basis, ACB, a policy loan is treated as a debt against the policy's value. The loan does accrue interest, but the principal amount is not taxable upon receipt. This strategy allows policy owners to use their policy's equity as collateral without immediately impacting the policy's tax-exempt status or incurring taxes on the withdrawn amounts. Question 5. In Canada, what is the primary purpose of the Capital Dividend Account, CDA, when a corporation owns a life insurance policy on a key person? A. To allow the corporation to deduct life insurance premiums as a business expense. B. To facilitate the tax-free distribution of death benefit proceeds to shareholders. C. To enable the corporation to treat the death benefit as taxable income. D. To provide a tax deferral on the policy's accumulating cash value. Answer: B. To facilitate the tax-free distribution of death benefit proceeds to shareholders. The Capital Dividend Account, CDA, is a notional tax account for private Canadian corporations that allows for the tax-free distribution of certain capital receipts, including the tax-exempt portion of life insurance death benefits, to shareholders. When a corporation receives a tax-exempt death benefit from a policy it owns, the amount exceeding the adjusted cost basis, ACB, of the policy is credited to the CDA. This allows the corporation to pay tax-free capital dividends to its shareholders, which is a significant tax planning advantage, especially for family-owned businesses. The CDA ensures that the death benefit, which is tax-free to the corporation, can also be distributed tax-free to its owners. Question 6. A universal life insurance policy in Canada allows the policy owner to contribute funds in excess of the cost of insurance, COI, and expenses. What is a key tax implication of maintaining a significant buildup of cash value in this type of policy? A. The cash value growth is fully taxable each year. B. The policy may lose its tax-exempt status if the accumulated funds exceed prescribed limits. C. All withdrawals from the cash value are considered taxable income. D. Policy loans taken against the cash value become immediately taxable. Answer: B. The policy may lose its tax-exempt status if the accumulated funds exceed prescribed limits. In Canada, universal life policies are designed to accumulate cash value on a tax-deferred or tax-exempt basis, but they must meet certain tests, such as the exempt test, to maintain this status. If the accumulated cash value within the policy exceeds prescribed limits set by the Income Tax Act, the policy may de-exempt, meaning its future investment earnings become fully taxable each year, much like an unregistered investment account. These limits are in place to prevent life insurance policies from being used primarily as tax shelters rather than as insurance contracts. Therefore, it's crucial to monitor the funding levels of a universal life policy to ensure it maintains its tax-exempt status. Question 7. A Canadian client is considering a deferred annuity and is concerned about protecting their principal from market volatility while still participating in some growth. Which type of annuity would best address this concern? A. A prescribed annuity. B. A variable annuity. C. A fixed-indexed annuity or equity-indexed annuity. D. A single premium immediate annuity. Answer: C. A fixed-indexed annuity or equity-indexed annuity. A fixed-indexed annuity, also known as an equity-indexed annuity, is designed to offer principal protection while still allowing for participation in market gains, typically linked to a specific market index. The principal is guaranteed, meaning the investor will not lose money due to market downturns. However, the upside participation is often capped or limited by a participation rate, rather than offering full market returns. This type of annuity appeals to conservative investors who want some growth potential without exposing their capital to direct market risk. It's a balance between the guarantees of a fixed annuity and the growth potential of a variable annuity. Question 8. What is the primary difference between a revocable and an irrevocable beneficiary designation on a life insurance policy in Canada? A revocable beneficiary can receive policy dividends, while an irrevocable beneficiary cannot. B. An irrevocable beneficiary has vested rights in the policy and must consent to any changes affecting their interest. C. A revocable beneficiary designation is only valid if the policy owner is deceased, while an irrevocable one is always valid. D. An irrevocable beneficiary designation allows the policy owner to change the beneficiary at any time without notice. Answer: B. An irrevocable beneficiary has vested rights in the policy and must consent to any changes affecting their interest. The key distinction between a revocable and an irrevocable beneficiary in Canada lies in the rights vested in the beneficiary. With a revocable designation, the policy owner can change the beneficiary, borrow against the policy, or surrender it without the beneficiary's consent. Conversely, an irrevocable beneficiary has a vested interest in the policy, meaning the policy owner cannot make any changes that would affect the beneficiary's interest, e.g., changing the beneficiary, surrendering the policy, taking a loan, without the irrevocable beneficiary's written consent. This provides a higher level of security for the beneficiary but restricts the policy owner's flexibility. Question 9. An individual applies for a life insurance policy and makes a material misrepresentation on their application. The insurer discovers this misrepresentation during the underwriting process, before the policy is issued. What action will the insurer most likely take? A. Issue the policy as applied for, but with an increased premium. B. Issue the policy as applied for, but with a reduced death benefit. C. Decline to issue the policy or issue it on amended terms. D. Pay the applicant the amount of the first premium, less administrative fees. Answer: C. Decline to issue the policy or issue it on amended terms. If an insurer discovers a material misrepresentation during the underwriting process, before the policy is issued, they have the right to decline to issue the policy or to issue it on amended terms. A material misrepresentation is a false statement that would have influenced the insurer's decision to issue the policy or the premium charged. The insurer's goal is to accurately assess risk, and if the information provided is inaccurate, they cannot make an informed decision. For instance, if an applicant fails to disclose a serious medical condition, the insurer might either decline coverage entirely or offer it with a higher premium or specific exclusions. Always be truthful on applications, as honesty from the start ensures a valid contract. Question 10. Which of the following statements about the tax treatment of policy loans from a Canadian life insurance policy is accurate? A. Interest paid on a policy loan is always tax-deductible for the policy owner. B. The proceeds of a policy loan are considered taxable income upon receipt. C. Interest on a policy loan is generally not tax-deductible unless the loan is used to generate investment income. D. A policy loan reduces the adjusted cost basis, ACB, of the policy, increasing future taxable gains. Answer: C. Interest on a policy loan is generally not tax-deductible unless the loan is used to generate investment income. In Canada, interest paid on a policy loan from a life insurance policy is generally not tax-deductible for the policy owner, as the loan is typically used for personal purposes. However, if the funds from the policy loan are demonstrably used to generate investment income, e.g., to purchase shares or an income-producing property, then the interest paid on that specific portion of the loan may become tax-deductible under the Income Tax Act. The principal amount of the loan itself is not taxable income upon receipt, as it is a debt, not a distribution of earnings. This distinction is crucial for tax planning, as it impacts the true cost of borrowing from your policy. Question 11. A Canadian employer offers a group life insurance plan to its employees. When an employee terminates their employment, they typically have the option to convert their group coverage to an individual policy. What is a key characteristic of this conversion privilege? A. The employee must undergo a new medical examination and prove insurability. B. The individual policy obtained through conversion will usually have lower premiums than comparable new individual policies. C. The conversion must typically occur within a specific time frame, and the new policy is usually a permanent plan. D. The death benefit amount on the converted policy must remain identical to the group coverage amount. Answer: C. The conversion must typically occur within a specific time frame, and the new policy is usually a permanent plan. The conversion privilege in group life insurance allows a departing employee to convert their group term coverage into an individual permanent life insurance policy, typically a whole life or universal life policy, without providing evidence of insurability. This option usually must be exercised within a specific time frame, such as 30 or 31 days after termination of group coverage. While the premiums for the converted individual policy will be based on the insured's attained age and standard rates, this feature is invaluable for individuals who might otherwise be uninsurable due to health changes. It serves as an important safety net for employees leaving a group plan. Question 12. A client has a participating whole life insurance policy. Which dividend option allows the policy owner to use the dividend to purchase additional paid-up insurance coverage, increasing the death benefit and cash value? A. Cash option. B. Reduce premium option. C. Paid-up additions option. D. Accumulate with interest option. Answer: C. Paid-up additions option. The paid-up additions option allows the policy owner to use the annual dividends from their participating policy to purchase small, single-premium paid-up whole life insurance policies. Each of these mini-policies adds to the total death benefit and cash value of the original policy. This option is particularly attractive for clients who want to increase their long-term coverage and accelerate the growth of their policy's cash value without undergoing additional underwriting. It's a popular choice for maximizing the policy's benefits over time. Question 13. Which of the following describes the purpose of a suicide clause in a Canadian life insurance policy? A. It denies the death benefit if the insured commits suicide at any time after policy issue. B. It prevents the insurer from denying a claim if the insured commits suicide after a specified period, usually 2 years. C. It allows the insurer to pay a reduced death benefit if suicide occurs within 5 years of policy issue. D. It provides a special exclusion for suicide when the insured has a history of mental health issues. Answer: B. It prevents the insurer from denying a claim if the insured commits suicide after a specified period, usually 2 years. A suicide clause in a life insurance policy states that if the insured commits suicide within a specified period, typically 2 years from the policy's issue date, the insurer will only return the premiums paid, without interest, and will not pay the death benefit. However, if the suicide occurs after this 2-year contestability period has passed, the full death benefit will be paid to the beneficiary. This clause is designed to protect insurers from individuals purchasing a policy with the intent to commit suicide immediately. It's a standard provision that balances insurer protection with policyholder rights after a reasonable period. Question 14. What is the primary role of a needs analysis in life insurance planning for a Canadian family? A. To determine the maximum amount of insurance a client can afford based on their income. B. To calculate the amount of life insurance required to meet future financial obligations if an income earner dies prematurely. C. To compare the cost of various life insurance products from different insurers. D. To assess the client's current health status and determine their insurability. Answer: B. To calculate the amount of life insurance required to meet future financial obligations if an income earner dies prematurely. A needs analysis is a crucial financial planning tool used to determine the appropriate amount of life insurance coverage a family requires to cover their financial obligations and future goals should a primary income earner die prematurely. This analysis considers various factors such as outstanding debts, mortgage, loans, future expenses, education, retirement for surviving spouse, immediate expenses, final expenses, probate, and income replacement needs. The goal is to ensure that the surviving family members are not financially burdened by the loss of the insured's income. It provides a comprehensive picture of financial requirements, moving beyond simply purchasing some insurance. Question 15. In Canada, what ethical principle is breached if an agent encourages a client to replace an existing life insurance policy with a new one that offers no clear advantage to the client, solely to generate a new commission? A. Adverse selection. B. Twisting. C. Rebating. D. Misrepresentation. Answer: B. Twisting. Twisting is an unethical and illegal practice where an agent induces a policyholder to lapse, forfeit, or surrender an existing life insurance policy to purchase a new one from the same or a different company, when the new policy offers no true benefit or is actually detrimental to the policyholder. This often occurs when the primary motivation is for the agent to earn a new commission. It's crucial for agents to prioritize the client's best interest and ensure any policy replacement genuinely improves their financial situation. Always remember that replacing policies without a clear benefit to the client is a serious ethical violation. Question 16. A client holds a universal life policy and designates their minor child as the sole beneficiary. If the insured passes away while the child is still a minor, what is the most likely way the death benefit will be managed in Canada? A. The funds will be paid directly to the minor child upon the insured's death. B. The funds will be held by the insurer until the child reaches the age of majority. C. The funds will typically be paid to a court-appointed guardian or trustee on behalf of the minor. D. The policy will be automatically voided, and premiums returned to the estate. Answer: C. The funds will typically be paid to a court-appointed guardian or trustee on behalf of the minor. In Canada, a minor child cannot legally receive or manage a large sum of money, such as a life insurance death benefit, directly. Therefore, if a minor is designated as the beneficiary and the insured passes away, the death benefit will generally be paid to a legally appointed guardian, trustee, or the public trustee/office of the children's lawyer, who will manage the funds until the child reaches the age of majority. To avoid the complexities and costs of court involvement, it's often advisable for policy owners to establish a formal trust or name a legal guardian in their will to receive the proceeds for the minor. Planning for minor beneficiaries ensures the funds are managed responsibly. Question 17. Which of the following best describes the grace period provision in a Canadian life insurance policy? A. The period during which the policy owner can return the policy for a full refund after delivery. B. The period after the premium due date during which the policy remains in force and the premium can still be paid without penalty. C. The period during which the policy owner can request a policy loan without incurring interest charges. D. The period before the policy becomes incontestable by the insurer. Answer: B. The period after the premium due date during which the policy remains in force and the premium can still be paid without penalty. The grace period in a life insurance policy is a specified period, typically 30 or 31 days in Canada, following the premium due date, during which the policy remains in force even if the premium has not yet been paid. This provision allows the policy owner extra time to pay the premium without the policy lapsing. If the insured dies during the grace period, the death benefit is usually paid, minus any unpaid premium. This feature provides a safety net for policyholders who might accidentally miss a payment deadline. Question 18. A client is considering purchasing a term life insurance policy that allows them to convert the coverage to a permanent policy later without proving insurability. What is this specific feature called? A. Renewable term. B. Convertible term. C. Level term. D. Decreasing term. Answer: B. Convertible term. A convertible term life insurance policy contains a provision that allows the policy owner to exchange the term coverage for a permanent life insurance policy, like whole life or universal life, at a later date, without the need to provide evidence of insurability. This feature is invaluable as it guarantees the insured's ability to obtain long-term coverage regardless of any changes to their health status. While the new permanent policy's premiums will be based on the insured's attained age at conversion, the convertibility ensures continuous coverage. It's a great option for those who need affordable coverage now but anticipate future permanent needs. Question 19. An individual is deemed to be in a substandard risk classification by a life insurer during the underwriting process. What does this classification generally imply? A. The applicant will be declined for coverage due to high risk. B. The applicant will receive coverage at standard premium rates with no additional charges. C. The applicant will likely pay a higher premium due to increased risk, or have limitations on coverage. D. The applicant is considered a preferred risk and will receive a discount on premiums. Answer: C. The applicant will likely pay a higher premium due to increased risk, or have limitations on coverage. A substandard risk classification indicates that the applicant presents a higher than average risk of dying, based on factors such as health conditions, hazardous occupations, or dangerous hobbies. To compensate for this increased risk, the insurer will typically issue the policy at a higher premium rate, often referred to as a rated policy, or may include specific exclusions or limitations on coverage. This allows the insurer to accept individuals who might otherwise be uninsurable at standard rates, making coverage accessible to a broader range of people. Always be transparent about all risk factors during the application process. Question 20. What is the primary purpose of the automatic premium loan (APL) provision in a whole life insurance policy? A. To automatically grant a loan to the policy owner whenever they request cash value. B. To prevent the policy from lapsing by automatically using the cash value to pay an overdue premium. C. To automatically increase the policy's death benefit whenever the cash value grows. D. To allow the policy owner to automatically deduct premium payments from their bank account. Answer: B. To prevent the policy from lapsing by automatically using the cash value to pay an overdue premium. The automatic premium loan (APL) provision is a non-forfeiture option in a whole life policy that acts as a safety net. If the policy owner fails to pay a premium by the end of the grace period, the APL provision will automatically activate, using the policy's available cash value to pay the overdue premium as a loan. This keeps the policy in force and prevents it from lapsing, protecting the insured's coverage. While the loan accrues interest, it ensures that coverage remains active until the cash value is exhausted or the loan is repaid. Question 21. A client is concerned about the impact of inflation on the purchasing power of their life insurance death benefit over time. Which rider could be added to a permanent life insurance policy to address this concern? A. Waiver of premium rider. B. Accidental death benefit rider. C. Guaranteed insurability rider. D. Cost of living adjustment, COLA, rider. Answer: D. Cost of living adjustment, COLA, rider. A cost of living adjustment, COLA, rider allows the death benefit of a life insurance policy to automatically increase periodically, typically linked to an inflation index like the Consumer Price Index, CPI, without requiring the insured to prove insurability. This rider helps maintain the purchasing power of the death benefit over the long term, ensuring that the coverage remains adequate to meet future financial needs, which might have increased due to inflation. While premiums will also increase to cover the additional coverage, it's a proactive way to combat the erosion of benefits by inflation. Question 22. In the context of a life insurance policy, what does absolute assignment refer to? A. The temporary transfer of policy rights as security for a loan. B. The complete and permanent transfer of all rights of ownership in a policy. C. The designation of an irrevocable beneficiary. D. The policy owner's right to receive policy dividends in cash. Answer: B. The complete and permanent transfer of all rights of ownership in a policy. An absolute assignment involves the complete and permanent transfer of all rights of ownership in a life insurance policy from the original policy owner to a new owner. This differs from a collateral assignment, which is temporary and serves as security for a debt. With an absolute assignment, the original owner relinquishes all control over the policy, including the right to change beneficiaries, take loans, or surrender the policy. This type of assignment is often used in situations like gifting a policy or transferring ownership as part of an estate plan. Question 23. A Canadian corporation is considering purchasing a key person life insurance policy on its CEO. Which of the following statements regarding the tax implications of such a policy is accurate? A. The death benefit received by the corporation is always fully taxable. B. Premiums paid by the corporation are generally tax-deductible as a business expense. C. The cash value growth within the policy is tax-exempt as long as the policy qualifies. D. The corporation can declare the death benefit as an ordinary dividend to shareholders. Answer: C. The cash value growth within the policy is tax-exempt as long as the policy qualifies. In Canada, if a corporation owns a life insurance policy and the policy qualifies as an exempt policy under the Income Tax Act, the growth of the policy's cash value accumulates on a tax-exempt basis. This means the investment earnings within the policy are not subject to annual taxation. While premiums paid for key person life insurance are generally not tax-deductible, and the death benefit is received tax-free by the corporation, and often credited to the Capital Dividend Account for tax-free distribution to shareholders, the tax-exempt accumulation of cash value is a significant benefit for corporate policyholders. Question 24. What is the primary regulatory body responsible for overseeing the conduct of life insurance agents and companies in Ontario, Canada? A. The Canadian Life and Health Insurance Association, CLHIA. B. The Financial Consumer Agency of Canada, FCAC. C. The Financial Services Regulatory Authority of Ontario, FSRA. D. The Office of the Superintendent of Financial Institutions, OSFI. Answer: C. The Financial Services Regulatory Authority of Ontario, FSRA. In Canada, the regulation of insurance companies and agents is primarily done at the provincial level. The Financial Services Regulatory Authority of Ontario, FSRA, is the regulatory body responsible for overseeing the conduct of insurance companies, agents, and other financial services providers within Ontario. While bodies like OSFI regulate federally incorporated financial institutions and CLHIA sets industry standards, FSRA is directly responsible for licensing and regulating agents and ensuring compliance with provincial insurance acts in Ontario. Always remember that provincial regulators are key to agent licensing and conduct. Question 25. A client is considering purchasing a whole life insurance policy with a paid-up option at age 65. What does this option imply? A. The policy will automatically mature and pay out the cash value at age 65. B. The policy will continue in force until maturity, usually age 100 or 121, but no further premiums will be required after age 65. C. The policy's death benefit will increase significantly at age 65 without additional cost. D. The policy owner can surrender the policy for a tax-free lump sum at age 65. Answer: B. The policy will continue in force until maturity, usually age 100 or 121, but no further premiums will be required after age 65. A paid-up option at a certain age, like 65, means that the policy owner will no longer be required to pay premiums after reaching that specified age, yet the whole life policy will remain in force for the rest of their life, until maturity, often age 100 or 121. The death benefit and accumulated cash value will continue to grow without any further premium payments. This feature is appealing to clients who want to ensure lifelong coverage but wish to stop premium payments by a certain retirement age. It provides financial predictability and peace of mind in later years.